JP Morgan, a clear winner, up 6% in the past 2 months, while the KBE is down 5%. Our next guest favors the larger banks. He says more business will still flow that way. Mike Mayo is here on set with us, senior banking analyst and managing director at Wells Fargo. Welcome.
Thanks for having me.
Never a dull moment. Can I just ask you about the goal? I know Goldman is a little bit off topic, or maybe it's not, but of the major banks that should be doing so well right now, this is an investment bank. There are no deals. What is your rating on Goldman, and what should they do at this point?
Well, I think Goldman's positioned well for the next several years. Remember, Goldman and the large banks fired nobody during the pandemic. So a lot of what's happening at Goldman now is simply a catch-up in pruning of the lowest performers. So I wouldn't have too much for a read into that. I mean, you do have lower for longer investment banking. It's taking longer for all kinds of deals to come back. On the other hand, several bank CEOs said at our conference a couple weeks ago, they see green shoots. So pruning, and it also sends a message. If you're not coming back to the office now, you're probably going to go back to the office after these layoffs. So I think these firms are trying to send a message that bring that intensity level back up to where it was before the pandemic.
It's an interesting point, but I wonder, to kind of bring this back to the whole banking sector, the place you want to be right now is in that kind of, what would we call it, bread and butter consumer business, right? I mean, or maybe you don't want to be if you have to pay out 5%, but their troubles with Marcus seem to have happened at exactly the worst time, because wouldn't that be the place to lean on for offsetting strength right now?
For over 150 years, Goldman Sachs' greatest strength was their investment banking and capital markets businesses to large corporations and investors. They went out of their lane with Marcus. That was a mistake. I said it was a mistake from day one. They're retreating from that now. That's the right move. Better late than never.
Sure.
So let's talk a little bit about those big banks and how they have been able to, well, I guess, sidestep some of the things that happened to the mid-size and the regional banks. You've got rising interest rates, and they seem to have stepped around that. You've got reduced deal flow, and they seem to have been making do with whatever deals they've got. You've got the issues of the banking crisis in the mid-sized bank, but they seem to have sort of stepped around that. What are they doing right? What is it that is native to those big banks that makes them your choice now?
Well, Tyler, I think you're summing up consensus right now, and I know you like me bringing props every now and then. So you're describing, I think, the typical bank stock investor, and the typical bank stock investor is in the dark.
Yeah.
So what we did with the new report today...
I like you better with it on.
You're not the only one. But we said, let's do a kitchen sink analysis of banks. And we said, let's assume deposits go down by another 8%. Let's assume Fed funds goes down to 2.75%. That really squeezes the net interest margin. Let's assume a recession with higher credit losses. And let's assume a lot higher regulatory costs. So you throw in that kitchen sink, and earnings get hurt at the regional banks by 25%. Earnings get hurt at the largest banks by 5%, maybe 10%. So Goliath is winning. And so for all the actions the regulators have taken for the last 10 to 15 years since the global financial crisis, and a lot of it was to prevent concentration of power, the reality is business is flowing to the JP Morgan.
The business has gone there. It's the market, the hand of the market moving capital there, right?
And I know you're talking about $1 trillion market cap firms today with a new one entering that. JP Morgan has the possibility of becoming a $1 trillion market cap firm in, over the next 5 to 6 years.